Picture a future where Fortune 500 companies aren't just exploring blockchain, they're integrating it into their core operations. According to a recent survey by Coinbase, the world's leading crypto exchange, this future is not a distant dream. It's unfolding right now. A survey recently done by Coinbase revealed that 56% of Fortune 500 company executives are actively pursuing blockchain initiatives. From industry giants to agile startups and businesses, they are embracing blockchain's potential, from stablecoins to tokenized treasury bills. But the data actually shows that this adoption isn't confined to Fortune 500 titans alone. Coinbase's data also revealed that there was a 39% year-over-year surge in blockchain projects among Fortune 100 companies in Q1 of this year alone, underscoring a profound shift towards embracing blockchain's transformative power. Furthermore, this study clarified that there is an urgency for clear rules in the United States for crypto. It's very evident the US needs to retain its crypto developers and talent to maintain its leadership in technological innovation. It's quite evident that blockchain and crypto are penetrating traditional finance in a big way. For example, spot Bitcoin ETFs have amassed over $63 billion in inflows since January, breaking the world record. And with the Ethereum ETF right around the corner and gaining SEC approval, this has positioned us for further elevation in this market. Furthermore, the success of these ETFs demonstrates the mainstream acceptance of cryptocurrencies as viable investment vehicles, providing investors with new avenues for portfolio diversification. And speaking of diversification, the tokenization of real-world assets is exploding, with over 1,000% of an increase since early 2023, now exceeding $1.29 billion. The market for tokenized assets is projected to hit $16 trillion by 2030. That is rivaling the GDP of the entire European Union. This growth signifies a fundamental shift in how assets are managed and traded, with blockchain technology enabling fractional ownership and increased liquidity. BlackRock tokenized US Treasury Fund BUIDL recently surpassed Franklin Templeton's $368 million fund to become the world's largest of its kind, further illustrating blockchain's impact. BUIDL launched in March of this year, exceeding over $460 million, surpassing crypto-native firms like Maple Finance, which focuses on short-term cash instruments. BUIDL's success does highlight the superior performance and growing dominance of institutional blockchain products. Furthermore, Fidelity's international partnership with JP Morgan on a tokenized network underscores blockchain's real-world financial integration. This collaboration positions Fidelity alongside other major players in the tokenization sector and highlights the increasing interest in leveraging blockchain for real-world applications. The partnership aims to enhance liquidity, streamline operations, and improve settlement times, demonstrating the practical benefits of blockchain tech. However, transitioning to digital infrastructure does require overcoming challenges like legal considerations, identity standards, and data privacy. Collaborating with regulators is crucial to build an identity infrastructure supporting broader tokenization adoption while ensuring security and compliance. The financial services industry must address these challenges to fully realize blockchain's potential in transforming capital markets. There are a variety of blockchain projects out there that are focused on just this. A perfect example is this one right here that I recently discussed on the channel. But of course, we need to remember that the progress isn't just top down, but also ground up, and it usually is. Small businesses, the most trusted institutions in the US, are venturing into crypto now more than ever. As Coinbase's study shows, about 7 in 10, or 68%, believe crypto can help them address at least one of their financial pain points, primarily transaction fees and processing times. Coinbase's study goes on to say that small businesses are increasingly likely to seek out candidates that are familiar with crypto for finance, legal, or IT tech roles. This grassroots adoption underscores crypto potential to solve real-world problems and drives economic growth like you can never imagine. But in order to drive economic growth, the US must cultivate the much needed talent to avoid losing it overseas. The US continues to lose developer share, down over 14 points as Coinbase's study reveals. Only 26% of crypto developers are US based today. Fortune 500 executives revealed that their main concern is the availability of trusted talent and is now a top blocker to adoption. Now, although having Wall Street involved in once was and still partially is the Wild West of the financial world, it does unfortunately come at a cost, and that cost is risking the loss to the fundamental beliefs that have been adopted since Bitcoin's Genesis block, and that's ensuring crypto fulfills its promises of better access to financial services in the world. For the underbanked and the unbanked, about half, at 48% of Fortune 500 executives, say that crypto has the potential to increase access to the financial system and the ability to create wealth. And 79% of Fortune 500 execs want to start working on initiatives with crypto partners. And of course, I saved the worst statistic for last. 72% agree that having a USD-backed central bank digital currency keeps the US economy competitive globally, which is a statement I highly disagree with and makes me wonder, did we let the genie out of the bottle too soon? Speaking of letting genies out of the bottle, check out this video right here by my co-host Lise, where she shares her top altcoin for July. And it just happens that BlackRock is buying it as we speak.